Right. Thank you. And welcome once again to all of you who have joined us here. A special welcome to all the newcomers. Uh, Welcome to Get Set Up. So today we are having a special session on the great property myth. Is real estate really the best investment? This is part one. And so we'll be sharing part one, some of the details, and there's another session coming up, part two as well. So hang in there, keep all your questions ready, and Mr. Sridharan will be taking it. But before that, let me also introduce Get Set Up and Mr. Sridharan as well. Yeah. Okay. So in today's session, Mr. Sridharan will be talking about understanding the true cost of property ownership beyond just buying and selling, the risks of real estate investment, including liquidity concerns and legal complexities. Then also how the changing market trends and economic conditions that impact property values. Common misconceptions about real estate as a retirement asset. Exploring alternative investment options such as mutual fund, exchange traded funds, government bonds, fixed income instruments, and that may offer better returns with lower risks. Now, a little bit about Get Set Up, because a lot of people are here today are new. Here on Get Set Up, we are on a mission to help those over 55 years to learn new skills, connect with others, and also unlock new life experiences. Our goal here is to reduce isolation, loneliness, and equip all of you in this community with tools and knowledge to age independently. Our community engages in classes online. We do have lots of sessions online, as well as offline activities. We have many live activities happening in different cities. And we also travel together, both long trips and short trips, international, domestic, everything. So that's
Sorry to interrupt.
Yes.
You can probably.
Yes, Mr. Sridharan?
Yeah. So basically, you can talk about little about the Get Set Up. What you do exactly in terms of taking away people to various places.
Oh, lovely. Yes,
Getting it.
yes, of course.
That's
Yeah.
something you can probably talk
Yeah,
a
yeah.
little bit about it.
Definitely. So here on Get Set Up, we are all a community of who are all above 50 and 55. And we have wonderful sessions online as well as offline, like I was telling you. We have meetups in various places. We have games and fun and music. And online, we have dance and music and nutrition, wellness, yoga, all that you can look for to live a healthy, happy life is what we have for you online and offline. Now, offline, we have some very nice travel also coming up. We currently we are going to Dehradun next month. So we are about 35 people going to Dehradun. We just had a great annual meetup in Goa. And so our meetups are all very rich, filled with lots of fun, learning, entertainment, and we look around the place as well. So if you guys are interested in travel and anything to do with wellness or music and dance, you please get in touch with us. We'll be sharing a link on the chat. You can definitely join us. And all of you are most welcome to join us and share your experiences as well. And now to introduce our sponsor, Franklin Templeton. Franklin Templeton, I'm sure most of you must have heard about them. They are one of the largest asset managers globally with over 76 years of experience and currently managing assets globally to the tune of 1.58 trillion USD. That is as of Feb 28, 25. It has been a part of the Indian mutual funds industry for over 29 years. Franklin Templeton India offers a diversified bouquet of products spanning equity, debt, hybrid, and international funds, which may help the investors to meet your financial goals, actually. They have a rich history of being pioneers in many ways, like introducing the concept of SIP, Systematic Investment Plan, in the Indian mutual fund industry. Their global parentage and local market expertise position them uniquely in delivering value to investors. So that's about Franklin Templeton. Let me introduce our speaker today, Mr. Sridharan. I'm sure most of you who have been with us already know him well, but for the newcomers, Mr. Sridharan is a recipient of Associate Financial Planner title for retirement planning and employee benefits from the Financial Planning Standard Board. He's also an active contributor on personal finance magazines like Money Control, Financial Express, Times of India, and others. He's also worked with Funds India, Quantum, Allegro Capital. And he has he's been working 15 years as independent financial advisor as well. He has conducted many regular sessions on retirement planning across major PSU banks that include IOB, BOI, Indian Bank, Canara Bank, etc. And he's also taken sessions for Get Set Up, many sessions, in fact. He's a wonderful speaker. You can clarify all your doubts with him. Today's session is very special because this topic is we are taking it up for the first time. So keep your questions ready and you can put your questions on the chat, which we will answer all of them if time permits. Or you can also, towards the end, you can unmute and ask your question as well. So that'll be towards the end. For now, let me just hand over the session to Mr. Sridharan.
Yeah, thank you. Thank you for introducing me. And of course, we are going to talk about the investments in real estate, the myth and the reality. We are going to, divide this into two parts. One is actually today we are going to discuss about why real estate and what is the advantages and the disadvantages, and what is the, everybody feels about, real estate as an asset class, which could probably deliver super returns over a long period of time, and why they should not invest in real estate compared to other asset classes. And the second session, what we are going to discuss next week, is all about comparison of the real estate versus the other investment avenues which are available in the market. So when it is coming to real estate, when we are talking about real estate as a product, one is the residential property is one product that is available for individuals, and then there is a commercial property, and then third one is a agricultural property. See, now actually nobody is buying agricultural property because we don't have the wherewithal to hold on to it, and really, we are all working professionals and we don't know the technical know-how of agriculture. That is the reason why we are not buying the agricultural property. To be very precise, somebody is really interested in agricultural property, they can buy. There is no problem on that. We are not going to discuss about the agricultural property now. We are going to talk about the commercial and the residential property. So when it is coming to property investments, so this is something where everybody needs to have a property to live. And secondly, people are buying properties left, right, center because assuming that this will grow in the future. The income that are going to get out of the property is in two different forms. So one is there is a property appreciation. So the property value keeps increasing on a year-on-year basis. And the second one is the rental yield. So we will be getting rental income on the residential or a commercial property, which will probably provide you a kind of a regular income to the investor. So that is the main reason why everybody is looking at investing in property. So, but when we are investing in property, so what are all the key reasons? See, basically, why we are investing in property is there is a kind of urbanization happening across India. There are the tier 1 cities, tier 2 cities, and tier 3 cities. So the tier 1 cities have grown up significantly high. People are looking at investing in tier 2 cities, which they are expecting that to grow. So the urbanization is the key factor with which actually the property prices are moving up, and hence people are trying to invest in properties. And second is, there is a value appreciation. As I told you, the value appreciation that is happening across the property. But I will explain you, what has happened to the property and why when the property values keeps moving up and down. It is not that always the property values keeps moving up. So I'll tell you why, and that is something that we can discuss. And third reason why people are looking at property investment is cultural values. Basically, when we are talking about cultural values, in the sense, people are living in a small place, and then they wanted to go a bigger place and bigger apartments and bigger is what actually people are looking at it, and then they are keep investing in property. Now, actually, when we are talking about the rental potential, so the rental potential also, is getting up very closer when we are talking about the risks that are associated with the property. So, what are all the risks that are associated? The one is basically, the risk associated with the property is it is illiquid asset. So, when we wanted to buy a property, we have to invest huge amount. When we wanted to sell the property, when we wanted to dispose the property, when we wanted to sell the property, it is very difficult, because the liquidity factor is, we even the property, if you wanted to sell, even if it is in a good location or good geographical location, the selling part will be very difficult as an individual. But if you look at the builders or the promoters, they will be able to easily sell the property. But as an individual, we might be having one or two properties, which will be very difficult for us to sell. It takes minimum, 6 months, 1 year, and sometimes, it may take even few years as well. So I've seen a lot of clients having properties where they were not able to sell their properties for the long period of time as well. So the liquidity is the biggest concern when it is coming to property. And there is ongoing expenses. See, when it is coming to properties, there are complete ongoing expenses. The ongoing expenses might be in terms of your maintenance charges. If it is residential properties, all the maintenance charges have to be borne by the borne by the investor. And secondly, any kind of incidental expenses, we have to bear the incidental expenses in the sense, sudden repair that is happening to the properties and other things. The investor only has to bear the cost. And then apart from that, there is property tax. So the property tax has to be paid on time, and yearly, year on year, the property taxes also keeps increasing. That is also have to be borne by the investor. On top of it, the tenancy is the problem. See, basically, the tenant comes and goes. Every time the tenant comes and goes, we have to do the maintenance of the property. We have to do whitewash. We have to do, the small wear and tear expenses. And management of property is very difficult. I am telling you, even if you have property which goes for a rental yield, so the rental yield also is very, very less. So when we are talking about the city like Bombay or Delhi or Bangalore or any cities, the rental yields on the residential properties they are at not more than 2 to 3%. The highest rental yield is at 3%. So anything less than 3%, you are locking in your money, and then you are getting 2%, 3% interest. It is not a wise investment. When we are talking about the commercial properties carries its own risk. It carries different types of risk. When we are talking about the commercial properties, so we have to pay, we have to shell out a huge amount compared to the residential property, and it should be there in the prime location. And identifying and leasing out the property also, requires a different talent. And then management of property also requires a minimum, the different talent that is required. Whether we do possess all these things is something like a working professional or even a retired professional, it is very difficult for us to go and manage the property. So we as a kind of a working professional, it is very difficult for us to manage the property. What other risks that are carried in the properties? The risks that are there is basically the encroachment, and then probably the more and more expansion of urbanization or any city development. Then probably the metro construction or anything, the government also probably encroach the property for the expansion of the city. So that is one challenge that we have. And second is, there is a duplicate documentation and other things that will also hinder the property. See, somebody may acquire your property, and there is a lot of duplication of documents. Even actually, you might be the title owner, but there is a possibility that the properties will be the documents will be duplicated and then sell it to somebody else. So these are all the things one has to be very careful about it. So that is again the reason why it is very difficult for you to get into property. Another thing is, if you look at the present trend, see, actually, truly speaking, the way how we brought up is completely different from the way how our children is basically being growing up. See, when we are talking about the children who are born after 90s, basically they are looking at moving to many places across the country. So basically the property where you buy, it is immovable. So you cannot change property from India to Dubai, you cannot change property from India to Australia, which is very difficult. So from that perspective, the physical assets, which is considered to be very difficult to shift from one place to another place, that is another risk. So assuming you have let us say 5 to 6 properties that you have bought, presuming that your children might be growing up here, and then they will be looking after the properties. But in today's world, they are all moving across various countries. So maybe in the community that we have for the Get Set Up, all aged around 50 plus, so all your children might be settled down in other countries. So whether they are going to settle down here and or going to look after the property, very difficult. So when we are talking about selling the property and transferring the money, that is again a kind of a difficulties that we are going to face. And finally, there is another problem by all the property investors are facing, is the succession. So you need to basically, create a will, or you need to create a succession plan. You have to create an estate plan where after our life, actually, the properties have to be transferred to the children. So again, people are sitting in different places, different countries, and which is very difficult for any individuals to assess where your children are going to settle down, and hence it is again it is very difficult for you to transfer the money from India to other countries. So these are the basic reasons why one should consider the other alternatives. And second thing is, when we are talking about the how the property values are basically being increased. Basically, the property values will be increasing based on the inflation. When the inflation is high, your property prices will move up. When the inflation is low, the property prices may not be moving very, high. See, and when we are talking about real estate also from the economic perspective, it is again a cyclical, sector. So it is cyclical in the sense, every 8 years or 10 years is the cycle for real estate. Every 8 years, it goes to the peak, and then it will probably, drop its value. So when we are talking about 8 years, which period we are buying? Even we are talking about the property values might not be coming down over long period, but during the short period, there are two things that could happen to the property. One is actually the time correction or the price correction. Assuming what has happened in 2012 till 2020? Anybody who bought the property in 2012 got at a higher valuation because that was the peak season. That was actually for the real estate sector, that was considered to be the one of the peakest values that was there in 2012. Anybody who bought the property after 2012, they could have not been able to see the higher valuation till 2020, 2021. After 2020-21 only, the property value started moving up. So for the period of 2012 to 2020, the 8 years period, the property has not delivered anything more than 2% compounded average return. Compounded average growth rate is what we are talking about. 2 to 3% is the return that is being provided by the real estate sector in the last between 2012 to 2020. But if you look at 2004 to 2012, the property values have gone exorbitantly high. Anybody who bought the property in 2004 and who was trying to sell the property in 2012, that was actually is the peak time. So the entry exit time for the property also is very, very difficult. So might be, we come to know only when at the fag end of the property prices are at its peak value. So entry and exit also is very difficult. These are all another reasons why it's very difficult to predict the value of the property and then the growth rate, all those things which are very difficult. And when we are talking about the investment, property as an investment. So when we are talking about property as an investment, what could happen, when you are buying a property, there are two options. One is actually you have to, wipe out all your savings and then invest in one asset class because it requires a huge investment cost. So the cost of acquisition is very huge. So you might be buying a property in Bombay or Delhi or Chennai or Bangalore. Even if you wanted to buy a 3 BHK flat, it could cost not less than 2 to 3 crores. In I'm talking about the suburbs, not in the main city. If you plan to buy it in the main city, it could cost not less than 3 to 6 crores. That is what the cost one has to bear. But when we are selling out this money, assuming we get a rental income, assuming your retirement corpus is being invested in the real estate as a residential property, you could not get anything more than 2 to 3% as a yield. The rental yield is only 2 to 3%. So assuming you are investing, let's say about 2 crore in a property, and you are getting an income of the even any residential place, a good residential place, if you are investing 2 crore, if you are getting, let us say about let us say 50,000 rupees is the rental income. So you will be getting annually 60,000. That itself is on the higher side I am talking about. So the rental yields are only 3%. You might be saying that you are getting 50,000 rupees rental income on an investment of 2 crore. But the rental yield is only working out to be 3%. But what is the other cost that is involved? If you remove the other cost, the cost of maintenance of the properties or cost of the tax, even the rental income, you have to pay tax. So you might be under 20% tax or 30% tax, or if you're under any tax slab, then you have to include the tax also. So you're getting 3% yield, and let us say 1% goes for taxes if you are coming under 30%, and then other half a percent goes for maintenance. So the real rate of return after adjusting the tax, after adjusting the maintenance cost and other incidental expenses, the real yield one getting on the rental property is only 1.5%. Is this the worthwhile investment? That is something that one has to think about. Though, the property value may increase, but in reality, the residential property, if it is an apartments or a flat or commercial property, the residential property, after some point in time, there is a stagnation in the property prices, because any residential property which is considered to be a flat, after some point in time there could be a stagnation. So where your value might not be growing the way how it has grown in the first few years, and that too, you have to decide whether which cycle you are in. You are in the boom cycle or in the bust cycle, and how much period that you need to wait. So these are all the factors one has to look at it when you are investing in property. So one is you are you are completely sweeping all your accumulated corpus and then buying a real estate which is illiquid, and you are getting a rental income of 1.5%, and then you are taking a pain of managing the property and looking after the tenant. You should get a good tenant, bad tenant. That and all is again, is our emotional and mental, agony that might be, that we'll have to undergo. These are the troubles, that you might be facing in residential property. Again, when we are talking about buying a property at a loan. So when we are buying a property at a loan, the loan interest for the bank is basically about 9%. You are actually, buying the properties with the loan. You have to pay 20% and 80%. Even if you buy loan, you are paying bank 9% as the average interest rate. 8 to 9% or 9 to 10% is what the average interest that works out to be for the longer period. Because, the period is basically between 10 years to 15 years or 20 years. Even assuming somebody is in the age of 50 planning to buy a property for their retirement income. Let us assume, 50 years they are buying a property, and then 60 they retire and then trying to get a rental income. Even in that case, what is happening is the rental yield is only 3%, wherein you are paying the bank 9%. You are losing 6%. That is one. Second is, even assuming the property value increases by in average, last 10 years, 15 years, 20 years average, the property prices have increased to the level of 8 to 10%, not more than that. There are specific locations where it has given higher return, but there is an index that is available. So if we calculate with the index, that is basically, this is called a residential index. So this is actually, very recent development that has happened in the property, because, there is no data available to track the property value. That is the reason why they have created the index about 10 years back. And when we are talking about this index, the property has grown up between 8 to 10%, or in some locations it has delivered about 10 to 12% return. So when we are talking about the residential property which is growing at 10%, and along with the yield of, let us say about a rental yield of 3%, the maximum, the return on investment is 13%. But again, you have to discount the factor that the management cost and the taxes that you are going to pay, the property taxes that you are going to pay, all the expenses you have to negate. So that will be, again, 2% goes away for the 2% goes away for your expenses. So when 13% minus 2% is 11% is the return one is getting. On 11%, 9% is the, the interest one has to pay. So when we are paying 9%, you are getting only 2% return on all these things. Whatever you have to manage the property, identify the good property, identify the good tenant, identify, the better neighborhood, and then identify, property is not being encroached. You have to do all these maintenance and getting at a 2% return on investment, which is actually, literally is not a worthwhile investments. So From this perspective, yes, of course, real estate or residential property is not a better investment. Even otherwise, let us say, you invested in a property with your own money. We have to calculate what is the return you are getting after adjusting taxes, after adjusting the inflation. When we are talking about the inflation itself is 7%. The inflation is 7%, and then your return on investment. Let us assume the property is delivering 8% return, and the rental yields of 3%. I'm talking about the highest. 11% is the return you are getting, negating your 2% on all the expenses that you are incurring. So your real return is 9%, wherein the inflation is 7%. You are getting only 2% additional income. So 2% additional income, you have to undergo all this pain. So that is the reason why the residential properties is not considered to be a better investment avenue for managing your retirement corpus. And then when we are talking about the property values, so there are only two things that could happen. One is actually the time correction or the value correction. So typically in properties, normally, there is no value correction that happens, but it has also happened in a few of the cities during the global financial crisis, and also during the this one, during 2014 or 15, there was a correction that has happened to the property prices. When the property prices have corrected significantly by about 20%, there was the property prices was down by 20%. Again, there is another myth. I would say, I'll talk about the what do you call the time correction and the value correction. So predominantly the property value correction does not happen. That is what actually everybody considered that it is like the property values will never fail. Here what happens is only the time correction. Assuming you owe the property, assuming you owe the property which is considered to be 1 crore in value. So when you go and try to put on sale, when you go and try to put on sale, definitely it will not go for 1 crore. People might be asking for little less than what you are quoting, what the market values are. Then what we will do, we will not sell the property. We hold the property. We hold the property till you are getting the value of 1 crore. This is what we call it as time correction. So you are the seller. You will not be selling the property because you will be looking at the value what you want. This is what actually we call it as the time correction. Even when you are talking about the builders, where you go and buy the property, the builders will always keep their margins and they will sell the property. The day you bought the property, if you try to sell your property after, let us say, 1 month of registration, you will not get the value that you bought it for. That is for sure in the property, unless and until there is a more demand on that particular area. So that is actually something where it happens. Apart from that, there is another big challenge for the property is basically when you are selling it, there is no 100% white money will be given. So managing black and white is very difficult for professionals like you. So basically, you and me are basically, working professionals where we will not be able to handle cash at all. Because, the business people are the one who can probably handle cash is the cash that they are getting. But when you and me are the working professional where it will be very difficult for us to handle cash. So now actually, any city for that matter, any city for that matter, the property value, the guideline value and the market value or the two different aspect. Some places actually the market value is very higher, and the difference between the market value and the guideline value is so wide. The spread is so wide, and one has to take 30% cash or 50% cash. So anything ranging from 10% to 50% is what actually that is the market trends. So people are, if one of them are trying to sell the property, definitely they will be ready to accept cash, and managing cash will be very difficult for individuals. So this is again another problem, all the individuals are facing. So when we are talking about, yes, we were talking about the time correction and the price correction. So really, when we are trying to sell the property, the prices may not be at the rate at which you are buying. And when we are talking about the time correction, so the property that you bought in 2012, when you bought the property, let us say square foot of 10,000 rupees, all inclusive, that will be same as 10,000 rupees for a period, because why it is happening is in 2012, that was the peak time the property prices have gone up to the peak. Valuation in the sense you are buying some property which is at its peak. Peak in the sense the value of the property was supposed to be supposed to be sold at 100 rupees, which is selling at 130 rupees, but you bought for 130 rupees. But you will not be able to sell at 130 rupees. Why? Because you bought it at a higher price. So nobody else is ready to buy at the higher price. So you will be waiting for the property price to come back to 130 rupees. So that is where actually, the time correction happens. So from that perspective, what are all the different avenues that are available compared to property owing? So owing property compared to other products, basically there is fixed income products that are available. The fixed income products that varies from fixed deposits to post office schemes to, there are debt mutual funds, various products that are available, which will yield you about 7 to 8%. 7 to 8% is what the yield one can get out of the fixed income. And other avenue that is available is equity-based mutual funds that are available, and hybrid funds are available. These are all something, one can look at it. This is the alternate. The reason why I am talking about these things are basically, these are all liquid assets. So even if you wanted to do the transfer of assets, it is very easy. Even, the creating an estate planning using this also is easy. Succession also is very easy on the any of the financial products that you invest in. So fixed income products are available, equity based products are available, and somebody is very particular about, I wanted an equivalent to real estate. I want a product which is an equivalent to real estate, because I wanted to see someone actually has experienced the real estate investments in overall perspective. They can also look at the alternate investment space where they will be investing, in real estate indirectly. So you will be taking that risk, but still, you will be able to get the returns what you want. Basically, there are alternate investments funds where they will be investing in commercial properties and residential properties. So the commercial properties, you will be able to get the rental yield on the commercial properties, and whenever they are selling, the properties, you will be getting the profits that are available on the alternate investments funds. And residential also, there are some, alternate investment funds that are offering investing in the residential space, where you will be funding the companies for construction. Once the construction is being done and it is being sold, you will be getting a portion of their returns as the you will be getting the returns from the investments that you have made. This is another avenue that is available. On top of it, there is REITs and InvITs. So the REITs is real estate investment trust, which is basically a kind of, they will be doing all the residential, commercial property construction, building, maintenance, and selling. All these things will be done by these REIT people, and then you will be investing in their scheme, and you will get the benefits on getting the underlying investments, underlying returns, whatever is being given by this product is something that one can look at it. And REIT is one. And InvIT is basically, the infrastructure investment trust. So if you wanted to participate in India's investments in terms of the infrastructure development, you can also, invest in these products, and then you will be getting the benefits on the underlying products. So when we are talking about the physical real estate, I'm talking about the residential property or a commercial property, which is very difficult for you to manage, especially when we are talking about managing your retirement funds. It is not, advisable to invest in the residential commercial properties. Managing it will be difficult, and then even the return on investment also is not so lucrative, and succession planning also is very difficult. The estate planning also is very difficult, and then liquidity also is a problem. So these are the problems that we have. On top of it, though, it will grow in its value, these are all the risks that one has to take. Instead of that, it is always better you have one property for living purpose, and rest of all is basically, basically you can invest in other assets. So typically, diversification is the key factor with which you will be benefited. And again, depends on individual perspective. If some of you are able to manage the property in a better manner, it is always better to take a individual decision. To conclude, what are all the different avenues that are available is what actually we discussed. Instead of a real estate, residential or commercial properties, the alternate investment avenues that are available are basically, one can look at fixed income products if they are less the risk averse investor, and they can look at equity based products if they are ready to take some risk, and if they are willing to enjoy the fruit of real commercial experience, they can look at alternate investment funds. There also, it carries risk. Only timing is the risk. So if they are not able to sell the property, they have to wait for a time. So the time bound is the risk one carries with alternate investment funds. And if they wanted to, enjoy the benefit of a lending loan to the real estate people and then getting a higher returns, they can also look at alternate investment funds, specifically investing on residential space. And then REITs, InvITs are the index available, and this is also something people can look at investing in. So these are the different avenues that are available for any investors who wanted to invest in real estate. One can explore based on their requirement, and definitely the retirement corpus, managing, the retirement corpus and investing this retirement corpus into a real estate is not a wise idea. With this, I conclude. Next session, actually, we will discuss about whatever the products that we discussed, like your, the property versus the mutual funds, property versus the fixed income products, property versus your REITs and InvITs, or property versus the alternate investment funds. We do the comparison of the real estate investments versus this. And finally, we are talking about invested in a property 20 years and what is the return one get in their hands. when we calculate the real terms, so people might be, thinking that, I bought a property in 2000 and now it is 25 years now. In the last 25 years, 1 lakh investments would have probably grown to 3 crores or something, 3 crores or, 2 crores, whatever the numbers. So in reality, when we are working out the numbers, breaking that into the CAGR, the compounded average growth rate, it might not be anything more than 12% or 10 to 12% is the compounded average growth rate. One could have got it. But when we are talking about numbers, it is only in multiples of 10 times, 20 times, 30 times. But when we are talking in terms of the real, calculation in terms of CAGR, it is not more than 8 to 10%. So we look at different options, different, avenues, and what is the return on investments, and which is a better, investment avenue based on individual risk appetite is something that we will discuss in the next session. Any questions? I'm willing to answer now.
Yes, that was a really eye-opener session, Mr. Sridharan. Very nice and very well put. You really explained everything very well. So is there any questions? Would you people like to ask questions? Please put it on the chat, or you can even raise your hand and we can unmute and ask the question. Any questions, please? There was one, this thing on the chat which says demonetization time property correction happened. Now, I don't know whether he's making a statement or is it a question, demonetization period. I'm not sure what that is.
Yeah, during the demonetization period, see, basically, demonetization is the time where people realize that, they will not be able to handle cash. Basically, cash investment was more before demonetization. After demonetization, digital currency started playing a vital role, and hence there was a stagnation in the property prices also, because people are not willing to sell the property because they don't have cash, because during the demonetization all the cash was basically sucked out of the system. So people were actually not able to access the cash component, and during that time the property value also started decreasing. That is what actually he meant to say.
Okay. Asha, you can ask your question. Asha? Asha,
Hello.
yeah.
Hello. Yeah, good evening. Thanks for the session. This is a question for the youngsters, like somebody who's in mid-30s. If they wish to buy a property like residential, is it better to buy with loan and EMI, or if they have liquidity available, like, okay, their own savings, should they utilize that? Like,
To be very precise, if they are taking up a loan, that will be better. Basically, the loans are available at a cheaper price, because the loan availability at a 9%, the interest rates, and this money they can invest in a better investment avenue, because 30 is the age where their earning potentials are still high, and they will be able to easily repay their loans. That becomes the commitment, and this money they can put on to work with the higher returns. Basically, they can invest this money into a kind of the equity based products, which could probably deliver about 12 to 15% return. They can take a leverage whenever they find they were not able to repay their loan. They can always pull out money from the investments, and then they can pre-close the loan. The choice is theirs. So my recommendation to them is basically put this money, work harder for them, and ask them to start repaying the loan from time to time.
Okay. That was
thank
good.
you.
Minnie, I think Minnie also wants to ask a question. Minnie?
Yes, I have two questions. One spoke about the duplicacy phase in property. So how that went. And second
Voice is not clear.
the market going down, how is it started being down. So
Can you
I
just
mean,
type it in the chat box because your voice is not audible?
okay, I'll do that.
Yes, Madhavanji, please ask your question.
Good evening, Sridhar. How are you doing?
Yeah, good evening. I'm fine. How are you?
I am doing fine. Fantastic. Thanks for the thoughtful session. I like
Yeah,
to know, some time back we invested in the Power Grid Infrastructure Investment Trust. And
okay.
whatever the projected return, I feel it is not providing. What is your thought?
Power finance,
Power Grid Infrastructure Investment
power
Trust.
grid, right?
They, yeah, real estate.
Okay.
What is that? Whatever that what they have initially they came for 1 lakh rupees one bond, and then every quarterly they are paying out as dividend. But
Mhm.
over a period, what initially this I think this was the first issue it came up, but in that
Right.
field of but now that I don't think the return what they are projected we are not getting it. Whether what is your thought? Whether you have analyzed this because it is for a replacement for a debt instrument. What is your thought on that? Have you
Yeah, see, very
invested?
specific to this, actually, I'm not aware. See, one has to look at, this is specific to one single investments. Rather, actually, as a collective investments would be a better idea instead of investing in a single investments. That is something that I
Okay.
would suggest.
Okay.
Because single
Okay.
investment is again, you are taking risk on one single entity.
Oh, that's fine.
If it
But
is
infrastructure
collective,
investment is a new thing in India.
correct.
It was
Yes.
new thought now that some of the India Mart also came up like that in a recent time that I want to understand. What is there a
Right.
better alternative available or something? PG Invit, actually, that is
Okay.
a code.
Right.
Okay.
Let
Thank
me
you.
just check and come back to you on that.
Okay. Check. Thank you.
Okay.
Thank
Yeah.
you.
So Minnie's question is how to prevent duplicate of papers. Now, I'm not sure what Minnie means by that. And her other question is, with the equity market so volatile nowadays, what are your views on this?
Okay. See, first question is how to avoid duplicate papers. See, basically, you have to ensure that every year you take the encumbrance certificate from the registration office to ensure that the documents are there in your name. That is the first proof that you have. So every year we have to meticulously, do this to ensure that the papers are not changed. That is the first and foremost thing that you can ensure that it is not being changed. Second is equity market. Yes, of course, it is volatile. It is meant for volatility. It is like an ECG where it has to go ups and downs. If there is a straight line, then the equity market is dead. So that is the reason why the equity markets keeps moving ups and downs. And having said that, the volatility over a long period, I am talking about 5 years or 10 years, 15 years or 20 years, the negativity or the volatility is not there. So the dot might be bigger, dot now, but if you just expand it for another 5 years or 10 years, the volatility becomes reduced and the returns actually, increases. When we are talking about India, yes, of course, the last 45 years GDP for India is at 6.66% is the average GDP. And in the same period, the inflation is averaged out to 6.2%. But overall, nominal GDP is at 12%. So that is the reason why, expecting a 12% return from the equity market is still doable from a long-term perspective. Though short-term, it could be volatile. One has to stay invested for at least, 5-7 years to avoid this volatility.
One last question, Mr. I don't know if it's KGY. You can unmute and ask your question, please.
Yeah. So I'm sorry, I was a bit late to enter. Recently, in our own family, we had a 3,800% return and another 200% return. on retained real estate that was sold. Okay. So, except for these high priced apartments in metro cities, where they sell you about 1,500 square foot for 2 crores, 3 crores, 3.25 crores, etc. If you really invest in real estate, I have seen with my own eyes that the returns are quite mind-boggling.
So it is specific to city, sir. So there is no guarantee that everybody gets this return. See, when we are talking about generalization and
No,
specification.
I'm not talking about generalization. I'm talking about 3 or 4 specific cases in our family. Okay.
No, that is what I'm talking about. These are all more specifics. Even actually in equity, there are specific equities, there are specific scripts that has given 200%, 300% return in one single year itself.
I agree.
So
I agree.
that cannot
But
be considered. No,
on
that cannot be
on the flip side, certain very carefully selected mutual fund investments over a period of 15 to 16 years, the return has been actually they publish 24%, 28% and all that. The actual return seems to be hovering between 12 and 15% per annum only, not accounting for inflation.
No, see, basically, when we are talking about investments, when they are talking about their returns is basically based on 1 rupee invested in their scheme when they launched. Till, assuming if you would have stayed,
No.
but we have not stayed
Well,
back.
I can't invest 1 rupee now. The fund is selling at a high price. There's no way of investing 1 rupee and buying 1 unit.
No, sir. Actually, I'm just talking about the unit price.
What I am trying to tell you is the return percentage given by the companies are not exactly what you see in actual point of fact.
No. That is what I'm saying.
Mr.
One thing,
Vishwanathan,
the
sorry,
returns.
Mr. Sridharan, we are already past time. I can just one more question, if you don't mind. Mr. Vishwanathan is waiting. The question is, when can we sell apartment and come out? And he's also asking, just a minute. That's his question. When can we sell the apartment and come out?
See, ideally, an apartment, which becomes
When the price is good.
aged after 20 years.
After 20 years.
After 20 years, it just gets stagnated. The price movement may not be there so much.
Okay, great. I hope that answers your question, Mr. Vishwanathan. And thank you so much, Mr. Sridharan. That has been a wonderful session. We're having another session coming up, the part 2 one. So all of you, please, I'm looking forward to seeing all of you there for that session as well. It's going to be as interesting as what we had today. So we'll be sending out the session links as always. Please do log in and join us for a next wonderful informative session on real estate. Thank you, Mr. Sridharan. And thank you everybody for joining us.
Thank you.
Thank you. Bye-bye.